Hello everyone and welcome to today's webinar on finance mantras for the entrepreneurs. My name is Varun and I am the host for the day. A quick line about myself: I head the marketing for Zoho Books, which is a leading cloud accounting player in Indian market, and also we have multiple editions for different regions and different world countries. With me, I have a special guest. She wears multiple hats, a dual degree holder in chartered accounting and cost accounting and management. She occupies leadership roles with multinationals. She has completed an executive education from Harvard Business School, and she's also a high performance coach certified by International Coach Federation. And yes, she is the author of best-selling What the Finance and A Glance at the Unknown. Thanks for taking the time out, Sangeeta. So let's begin. It is always said that money can't buy happiness, but without money, I doubt there is any business that can sustain. So Sangeeta, do let us know, how critical is finance to any entrepreneur or a startup owner?
Hi Varun. So I do hear your question, but tell me, why does a business even exist? It's mostly passionate people who start their own business. But again, what is the root cause? What makes them want to start a business? Profits, I'm sure, is one of the ulterior objectives. Unless, of course, it's an organization that's meant for charity. So when the prime motto of any business is to make profits, it's important for an entrepreneur to manage his finances accordingly and do his very best. So prime focus needs to be given on finance. And one of the top reasons that businesses fail is because of lack of proper financial management. And therefore, I think it's very essential for any entrepreneur, irrespective of whatever line of business he or she is in, to give 100% to finance, because it is very, very critical for any business.
It's a known fact that finance is so critical to any business. So why is it so that finance always takes a backseat in comparison to sales or marketing?
Unfortunately, I think finance is looked upon as boring or a cumbersome process. And many entrepreneurs also find finance to be very challenging. But I think ignorance is one of the root causes, and I feel I'm here to create awareness and educate entrepreneurs, as finance cannot be ignored by any business owner. Because like we discussed, it's a crucial aspect and it's the backbone of any business. And I think, like I mentioned before, everybody needs to know the importance of finance, because I think it's the core of existence of any business. So an entrepreneur is, like a juggler, and he has to ensure that he's paying sufficient importance and giving sufficient attention to finance, is what I think.
Makes sense. So in case if I have to simplify by giving an example, I can think of finance being one of the legs of a tripod stand. A leg representing sales and marketing. The second leg can also represent your operations. But then third, of course, has to be your finance. It's only when all these three legs are properly calibrated that one can take a good click. So now that we have the base ready for this particular webinar, so how do we plan to take it up, Sangeeta?
Right. So for today's webinar, I'm going to take you through, simple steps that can be useful for any entrepreneur. And if you were to look at the agenda that I have for today, so the first thing that I'm going to talk about is to design a finance strategy. I think it's very essential for an entrepreneur to have a proper finance strategy in place, because that's what is going to help an entrepreneur to propel forward in his finances. And then we would look at decoding profit mantras. The profit, like we discussed, is the ultimate thing that any entrepreneur wants. So how can an entrepreneur decode his profit mantras? The most essential thing, the biggest challenge is cash for any entrepreneur. So let's see how we are going to decipher the cash management. And lastly, the decision making based on finance. So what are the areas an entrepreneur needs to focus in order to take the right financial decisions? So these are the 4 Ds that I'm going to concentrate upon today. And we'll deep dive into each of them to see how and what best steps an entrepreneur can take to make things work to his advantage. So let me move on. The first thing that I'm going to touch upon is financial strategies. So let me, set the context and give a brief. If you've read my book, What's the Finance, let me share a little tidbit from the book. So in this book, I'm talking about 3 founders who are called Sid, Ram and Isha, and they have started something called Sri Ventures. So as founders, all 3 of them wanted growth for their organization, which is fantastic. Like, most entrepreneurs, everybody is looking for growth. So they also wanted growth. However, each of them in their minds, this was the plan or this was the intention that they had for growth. One thought growth meant increasing the number of customers they had. Second one thought growth means increasing the prices, which would result in a top line growth. The third one thought growth means having a new vertical. Now, all 3 are talking about growth, but in different ways. So they're looking at things differently and they lacked clarity in thoughts, which then becomes a challenge because for a business, everybody needs to be on the same page and, thinking on the same lines. So it's extremely essential to have proper financial goals and you need to specify it. So financial goals are the key for any business. So what is financial goals? What is it that you want your business to achieve in financial terms? So clearly spell it out. Now to make things easy, I'm going to give you an acronym so that it becomes easy for entrepreneurs to remember it. So remember the name TOM, T-O-M, Tom. So I say T stands for the time frame, O stands for objectives, and M stands for measurement. So when I say time frame, the financial goals that you have, by when do you want to achieve? And what is your path ahead? So let's say what are your short-term financial goals, what are your medium-term financial goals, and what are your long-term financial goals. So by having the time frame, you are able to spread it out and plan yourself accordingly. Or like I said, is for your objectives. Your financial goals need to align with your business objectives. So, the both needs to be in the same direction because without having proper financial goals, it's like groping in the dark. You don't know what is next and it's like you're going around like a headless chicken. So it's important to have them in place. M is the measurement that I spoke about, to periodically measure yourself. You're not going to achieve anything overnight, right? So you need to give it time and pace yourself accordingly. At the same time, it's essential that you keep measuring your progress periodically. Let me again, take your attention to the information shared by Mr. Arun Jain of Expolaris. I've had a beautiful interview about him that's featured as part of stories. And in that, he said, it's so essential that your entire team is aligned to it. Now, in 1993, Polaris had a turnover of about 2 crore rupees. The vision that they had set for themselves and the financial goal that they wanted to achieve was by the year 2000, they wanted to become a 100 crore company in turnover. So this is the financial goal they set for themselves, and they had broken it down periodically to see how they were going to achieve it. So one of the things that Mr. Jain mentioned was, he along with his one-downs and their one-downs, so basically the entire senior management team had sat down and, strategized how they were going to achieve this from a finance perspective. So that is why I say it's essential to have financial goals so that the entire team is moving in the same direction. And that is exactly what I'm talking about, team alignment. It's not enough only if you have spelled it out in your mind, but it's very important that your entire team is aware of it, and as a team you're able to synergize together and move ahead. Next is your business plan. Again, you'll have to just write it down so that you can even refer to it at a future date rather than just having it all in your head. And not only for your own business, but even your bankers and your investors, everybody may want to look at your business plan to see how you're progressing, what is your plan for the future of your business. So this also gives you a clear picture and the direction and, helps you to grow your business in the way you want it. Next is your financial parameters. You need to have financial parameters because that's what is going to help you to measure and monitor your progress. It could be things like your return on capital employed, your gross margins, what is it that you're going to get, what about the net margin, your headcount growth, what is it that you want your headcount, let's say you're having X as your turnover, so what should be the proportionate headcount for it, what is your customer retention ratio, what about your IT cost per employee, the profit per employee, so on and so forth. So this varies, industry to industry, and depending on your business, you need to specify your important financial parameters so that you're able to measure and monitor your progress on a periodic basis. So again, list down what are the key financial parameters that are relevant to your business, so that you know how well you are able to plan and pace your growth. Another important thing tool that can help you here is also to have a proper budget in place, because a budget can help you track your progress. To see your budget has to be prepared in a conservative manner, because many times a lot of entrepreneurs have noticed that they have a lot of ambitious thoughts and thinking, and thereby they are projecting high revenues and lower costs, but in reality it turns out to be otherwise. So you might as well prepare it on a conservative basis and not have such a rosy picture, because you would know what is the realistic scenario. So prepare it on a realistic basis so that you know how well you're progressing and you're able to pace yourself accordingly. So with that ends my mantra number 1, and let's now look at mantra number 2. Mantra 2 is to do on the pricing strategy. Many times entrepreneurs tend to think, am I pricing my product or service in a right manner? Obviously, they don't want to overprice or at the same time, underprice, because overpricing, you have the risk of losing your customers, and underpricing, obviously, you don't make sufficient margin. So how can an entrepreneur arrive at the right pricing strategy? And they also have confusions to say like, when do I give discounts, or when do I run promotions, or is it just on an ad hoc basis? How exactly should I go about my pricing? Again, on the pricing, it's very, very important that you plug revenue leakages. I have seen many times that a lot of these entrepreneurs in the SME segment sometimes miss to invoice larger corporates, and revenue, if you don't raise an invoice, your revenue is gone. So you need to have a proper system in place and ensuring that every work that you undertake is invoiced, billed, and collected on time. So let me give you some tips to see how to arrive at a right pricing strategy. And you could also do a mix and match of these or see what is relevant for your business. Again, let me share another thought with you. In my book, What's the Finance, I have interviewed Ms. Ranjini Manian of Global Adjustment, and she had actually started a new industry. So, she didn't have anybody or any other competitor to benchmark herself. So you can read that to see how she arrived at her pricing strategy. So what is it that I have to share? One is on the perceived value. I have again, spoken about perceived value in depth in my book. But what exactly is perceived value? Now, just to make it simple for you, if you were the customer of the product or service that you're offering, how would you perceive it? How much would you be willing to pay for it? Let's say you want to buy a shirt. You may look at it differently if it is a branded shirt versus a non-branded shirt. A branded shirt is going to come to you at a premium because it has a brand value attached to it, because it's been perceived as something that gives you superior quality and it has some probably extra value about it. So how is your offering, be it your product or service, how is it being looked upon? What is the pain point your product or service is solving for your customer? What is the value that's going to bring about? Why should somebody even use your product or service? So to give you a better understanding, the car Nano that was introduced by the Tatas, it had this image that it's a cheap car. So, its features, everything came along with it. Now, there's nothing right or wrong about it, but it depends on how you want to position it strategically. So, what is your target audience and which is the market that you're going to cater to? So, depending on that is your perceived value. So, look at the perceived value that your product or service is offering. Next is the time cost. Time is an invisible cost. And like we know, time is also precious. You may sometimes wonder, why does time come with a cost? To make you understand better and easily, if you borrow money from the bank, there is an interest cost, which is nothing but, which is calculated in relation to the time. So time does come with a cost, and because it's invisible, sometimes we tend to miss the time cost. Now, services especially, when you're pricing, the services that you're offering or the time that you spend on developing your product, there is a time that's associated with it, which needs to be factored into your cost. So while arriving at your pricing, you need to include the time cost into it so that you're arriving at your right pricing. There could also be hidden costs. To give you an example, if you look through your bank statement, there could be direct debits by your bank for various charges that have been rendered by them. So those are hidden costs because it doesn't really come to your attention. So what are the hidden costs that are there in your business? You need to know them so that you can include them in arriving at your pricing. And if there are hidden costs, you can ensure that you're actually recharging them to your customer. But for you to do that, you need to be aware of what your hidden costs are. An easy way would be to arrive at your total cost and add the margin that you require. Now let's say your total cost is 90 and you want a margin of 10%, and thereby you arrive at your pricing of 99. So 90 plus the 10% that you want, so your selling price is 99. So while that is very easily said, you'll also have to keep in mind your industry trends. How much are your competitors priced at? What is your USP, which is your unique selling point? And what is it that you are offering that your competitors are not offering? So you'll have to look at it in a holistic way to see, how you can position yourself accordingly. You could also, work back on your pricing. Like for example, you want to price your product or service at 100. And you know that your costs are going to be 95. So which means you're left with a margin of 5. So you can play around with this to see, is a margin of 5%, is it okay for you, or is there a way you can reduce your cost, or, play around with your selling price. And it's all also dependent on the demand and supply that your product or offering has. Any thoughts, Varun?
Yes, Sangeeta. So in fact, when you were talking about these 2 points, I was thinking about how valid or how relevant it is to my line of work as well here in Zoho. So when it comes to defining the marketing goals or the marketing strategy as well, we have actually take into account all the pointers that you discussed. For instance, all our goals, they are very much time bound and they are all measurable. We have a budget as well, and then we also identify certain parameters based on which we can judge whether that particular strategy has worked or not. So I'm just able to correlate how this is even applicable in case of marketing. So financial strategy, yes, it's a very important and a valid point. And then of course talking about the pricing strategy. So again, from a business point of view, it's very important to get the price right. So that brings me to a question, Sangeeta. So how different is coming up with a pricing for a B2B company versus a B2C company? Or are these points still valid in both the cases?
It's rather subjective, but having said that, B2B, your volumes are much larger. So you could look at, offering maybe a discount based on volumes, whereas in B2C, it's rather limited. So you'll have to see how you're making it attractive for your customer, and it has to be in relation to the value that you're offering as well. So they go hand in hand, the value, the quality, the branding, and so on and so forth.
Got it. So in that case, I think we can move to mantra 3 and 4.
Sure. So mantra 3 is on profits, which is what any entrepreneur would like to have for his business. And how does one arrive at good amount of profits? While it is easily said, you can increase your revenues, you can decrease your costs, and you can also have good financial discipline, implement some best practices, adhere to compliances. Let's see how, as entrepreneurs, you can get in a little deeper into each of these and implement them in your business. So let's talk about the spend management first. So let me give you an acronym again here so that you can remember it more easily. C stands for cost control. So what are the measures that you're taking to keep your costs under control? What are the limits that you want to set? And is there a way you can reduce your costs? So as an entrepreneur, since you have the whole picture, you can decide to see which are the areas that you can implement better cost controls. A is alternatives. Now, are there better alternatives to a particular spend? Like let's say you're looking at moving from point A to point B. Now, if you want to get to point B, let's say you could walk it, you could take an auto rickshaw, you could take an Ola, you can take a metro, you can take a train, or probably even take a flight depending on where the place is. So what are your alternatives? Now, that doesn't necessarily mean you will have to take only the cheapest mode, because then your time cost will kick in. So let's say you're evaluating the options between taking a train versus taking a flight. The flight may help you reach faster. So it's not necessarily that you'll have to look at only the cheapest option. So see which is the best option and make it a win-win for you. R is to say whether it's required. Now, is an expense even required for you? Can your business do away without that expense? Or how is an expense contributing to the growth of your business? So, if I were to elaborate a little more, what is the return on expense? Now, what do I mean by return on expense? If, let's say you want to incur some marketing expenses, you may decide that it's worthwhile to spend on marketing because that's going to result in giving you higher sales, right? So you'll have to take a call wisely and be, judging each of your expenses to see if it's even required and, is it the right time to spend this amount. So remember CAR, so that's your cost control, what are your alternatives, and whether an expense is even required. So that is to do with your spend management. on maximizing your revenues. Like you could increase your revenue by increasing your number of customers. You could look at newer geographies, newer markets, or introduce newer verticals. Maybe you want to have a separate budget for your R&D and come up with some innovative products and basically see how you're going to value add. And again, I would like to link this back to the pricing strategies to see how you are able to maximize your revenues. Not just that, you can also look at different and alternate sources of revenue. For example, you could have your income coming from, let's say, rental income, investment income, dividend income, so on and so forth. You can also park your excess funds in have fixed deposits or liquid funds, so that the little amount of interest that you're gaining out of it is always good to have some extra money coming into your business. So plan it judiciously. And then comes your financial discipline, which I think is very, very essential. Simple things like reviewing your financial statements on a periodic basis, your monthly P&L statement. Are you even looking at it and seeing how you're progressing, how the business is progressing, and then you could even compute your variances. So variance is nothing but the difference between your budget and the actuals. So how is it your turnover is, how is your turnover as against the budgeted turnover? Is there an increase or a decrease? And if there is a significant variance, deep dive to find out what it is about. I've given you a whole lot of examples in the finance which you could refer to for better understanding. Here I would also like to talk about a recent encounter that I had with Mr. Nalli, who runs the huge retail store. I was so impressed with him because he was saying that he looks at his, the top line and his margins on a daily basis, because he says there are certain days of the week that the business does well and there are certain days when it's not so good. So I tend to compare it, with the previous year of each day. So, that's getting into real details as an owner. So if not that, at least, maybe you want to look at it on a bi-weekly basis or at least on a monthly basis, so that if there are any mistakes, you will be able to set it right subsequently. So your financial statements indicates the financial health of your business. So it's very important to get into these basic disciplines. And then you could also compute the product profitability or your department-wise profitability. How is each department contributing to the growth of your business and, towards the profit of your organization? These are few things that you could evaluate. Then comes the best practices. Now, what are the best practices that are relevant to your industry? The good thing about best practices is, they have all been tried and tested. So you just have to ensure to adopt it, whatever is suitable to your business, because a best practice ensures that, you have a smooth flow of operations happening. And if there is a challenge, you know how to handle it. It could also involve simple things like who has the authority to approve, let's say, a particular expenditure or getting into a contract or an agreement, and then what are the internal controls that you have in place, who is authorized to sign a check, or do you want to have dual signatories, which is always better, or who is authorized to sign a purchase order. So it's always have to, essential to spell these out. And you can also have very well written down policies and procedures, like, your travel policy, your purchase procedure, various things that are applicable to your company, fixed asset policy, so on and so forth. So it's always nice that, you spell it out and all gray areas are addressed, because if there is any ambiguity that arises at a later date, you can always refer to these policies and they act as the Bible for the organization. From here, let's move on to the compliances. While compliances, may not have a major impact in that year, at a later date, it impacts your financial statement. Simply because the cost of non-compliance is very high. So you might as well follow the rules and regulations so that you're able to focus on your business and able to have a hassle-free, smooth running of business. So essential to ensure that you are adhering to your income tax rules, your legal rules, and maybe you have industry-specific rules like your STPI, or maybe it could be SEBI regulations, RBI guidelines. And the best person who can help you out here is normally your auditor or your consultant. So if you have any clarifications, it's best for you to check them out and ensure that you are compliant with all the applicable rules and regulations. I would also like to briefly touch upon the difference between tax evasion and tax planning, because tax planning is important and tax evasion is something that which is not legally permitted. The major difference between the two is the intent, and by planning your taxes well, you are actually bringing down your tax burden. So therefore, ensure that you're not evading your taxes and you are actually planning your taxes very meticulously. And again, your tax consultant would be able to help you out here. So let me now move on to mantra 4, which is very interesting and very, very important for any entrepreneur. Because when I wrote my book, I realized, this cash management seems to be a common challenge for all entrepreneurs, irrespective of their nature and size of business, because the common thread that, most people said was, how am I going to pay the next month's salaries on time? I'm having nightmares, I'm having sleepless nights because, a whole lot of payments are due, and how can I manage my cash better? So I do understand that cash is of prime importance, naturally. So what can one do as an entrepreneur? So first, prepare a cash budget. Now, what is a cash budget? I mean, very simply put, what is the movement of cash that your business is foreseeing? Like, what is the money in and what is the money out that you're going to have for your business? So you have to prepare this on a periodic basis and keep updating it, as and when you're able to foresee any specific movement of cash for your business. So you probably may be in a position to know your cash outflow, because most of your expenses. And when it comes to your cash inflow, you probably will have an idea to see when each customer is going to pay or what your credit period is, and then based on that, you can devise a good cash budget. If you would like to see a good format of reference for the cash budget, you can always refer into my book, where I have illustrated with an example, and I think I have given about a 6 months cash flow projection. So you could use that template to prepare one. Now again, me being an acronym person, let me give you an acronym for cash management as well. So remember cash for cash. So C, I say collect on time. A stands for anticipate your inflow and outflow. S for systematically monitoring. And H for the habit of cash reserve. When I say collect on time, if you're in a cash business, well and good, you don't have the hassle of collection. But if you're not on cash and you're into credit business, the best thing, broadly, I would like to give you some ideas here. The best thing would be to see that you're able to get an advance from your customer. Now, if you're getting 100% advance, well and good. If not, at least 50% or whatever amount that you're able to get as an advance from your customer is going to help you. So therefore, try to see you're able to get an advance. Because again, when I was interviewing some entrepreneurs for my book, what I realized was some of them had actually customized their product, anticipating that they were going to get a particular business, and unfortunately the business didn't come through and the entire stock was not usable. So especially in cases when you're customizing it for your customer, ensure you're able to take as much as advance as possible. Next is to follow up. It's very, very important that you follow up for payment with your customers on time, because you're out of sight, you're out of mind. So you might as well be looked upon as a pain rather than, not collect your dues. So periodically keep following up with your customers. It could just be through a phone call or an email or WhatsApp or whatever, but it's essential to keep in touch and follow up for your dues. Remember that as your debt ages, your recovery, becomes the probability of recovery becomes lesser. So keep following up regularly, and in case you suspect that your customer is going through trouble times and may not have sufficient cash, whatever, you could probably offer them, let's say, a 5% discount if they were going to pay you before, let's say in the next 1 week or something like that. It's basically to see how you are able to negotiate well and get into the best way of recovering your money. The good thing is the MSME Act says that, I think within 45 days, all the debts have to be paid. So that is your advantage. Now, failing any of these, I think what you should do is, depending on the rapport you share with your customer, you may want to send out a legal notice drafted by your legal consultant or your lawyer. And thereafter, if you want, you could appoint a collection agent, and if still nothing really works, and if your customer has gone bankrupt or something, you just have to write it off as a bad debt. But apart from that, ensure that you're collecting on time, you're anticipating your inflow and outflow, and systematically monitoring what is due from each of your customer, because you need to know how much money is due to you as an entrepreneur. So if your customer is saying that, listen, I'm in a bit of a cash crunch right now and I'm going to pay you, let's say, after 2 months only, then you'll have to update your cash budget accordingly. Hedge, like I said, is the habit of creating the cash reserve, because you never know, when you may have an emergency, and basically save it up for a rainy day. The taxman may pop in and say that you owe an amount to be paid as taxes, or there could be some unforeseen circumstances, and it's always essential to have a sufficient cash reserve. So as an entrepreneur, both your cash profit is important and your book profit is also important. Your cash profit is important because your day-to-day operations, for that you need your cash, and therefore your cash profit is important from operational perspective. And from a financial perspective, your book profit is important because the book profit is what the bankers and the investors are going to look at. So both are important for an entrepreneur. But why does a difference arise between the two? It's because one of them is non-cash items, like depreciation, for example. It doesn't impact your cash, but then it has an impact in your books. There could also be a timing difference. Let's say you have invoiced one of your customers at little before the year end, so that will be reflected in your book profit. Whereas the customer, let's say, pays you after 2 months, and your cash profit is reflected in your cash situation only after 2 months. So there could be timing differences such as these that arise. And then it's because of the accrual system of accounting, because in your books, you will have to accrue for your, let's say, your leave salary, your gratuity, the bills that are unpaid, so on and so forth. So you will have to accrue for these expenses, but the physical payout may actually happen post the month end or the year end. So these are some of the reasons why there's a difference between your cash profit and your book profit. Varun, would you like to add on something here?
So, the things which you just covered in point number 3 and point number 4, I think here technology actually plays a very crucial part. So for instance, when we are talking about profit strategy, and we specifically touched the point of controlling the expenses and also compliance. So this is where an accounting software or maybe even an expense reporting tool can be very handy. So I just have a fun fact for the audience here. So in fact, we did a research and we found out that travel expense is the second most expense, the biggest expense that is contributing to your expense list after payroll. So this is something that which we often ignore, and it's also critical for us to plug this leak. So that's about the profit strategy. And of course, when we talk about cash management, yes, it's important for us to collect the money on time because that actually determines the state of the cash flow. So in case if you go with a modern accounting software like Zoho Books, which has a payment reminder, so it's easy for you to have some kind of control over your cash flow. That is what I can add to these 2 points here.
Sure, thanks for that, Varun. Interesting. So let me move on to the mantra number 5, which is on your financial decisions. A lot of decisions that an entrepreneur takes, has to be looked upon from a finance perspective, and some of the factors that an entrepreneur can consider is what I'm going to spell it out here. So, any business has its risk. So an entrepreneur needs to evaluate his risks. So it's always, they say taking no risk is the biggest risk. So an entrepreneur has to take risks, be it life or business, you have to take risks. But then how do you take calculated risks, right? I mean, that's what I think makes the difference. So again, me being the acronym person, I'll give you the acronym again. So remember risk for risk. So R stands for your rewards or your returns. So financially speaking, what is the returns that you're going to get, or what are the rewards that a particular financial decision is going to bring onto the table to you is one thing that you need to look at. I stands for the investment required. So you need to know what your investment is that is required, because you need to calculate your return on investment. Your investment is going to have an impact on your cash flow. So it's essential for you to know the investment amount that's required. S is for segregate. Segregate your pros and cons. So what is it that you're actually signing up for? You need to look at the advantages and disadvantages from the business perspective, so that you're basically aware of what it is, how it's going to impact you financially. K, I say, is knowingness. When I say knowingness, I mean know the facts, know your industry, know your market, know your customers, and what is it that you need to take the right financial decisions? What is it that you need to know so that it is in the best interest of your business and in financial terms as well. So these are some important parameters that you can consider. So let me reiterate. R is for rewards or your returns, I is your investment that's required, segregate your pros and cons, and K is your knowingness. And also financially speaking, all the financial decisions, you need to know what is the impact on cash flow that it has. Let's say you want to buy an equipment. So, what is the cash outflow that it has? If you're buying it on a one-off, it's okay, it's fine. You need to plan your cash budget accordingly. But let's say you're going in for a loan. Right, so you have your monthly loan repayment that you kick in, which will again have an impact on your cash situation. There could be periodic maintenance that is required for it, so which again impacts your cash flow. So you need to, look at every aspect of your decisions so that you know and you can understand the impact that it has on your cash flow. Similarly, what is the impact on P&L? Again, going by the same example of the equipment, it will have your depreciation charges. So that has an impact. Depreciation has an impact on your P&L. And if you've taken a loan, it has an impact on your interest charges as well. So look at it in a complete manner and see how it is impacting your business outcomes. Like how does it help you to grow? How is it contributing to the financial well-being, and are you able to cater to your customers better? So look at it in a holistic manner and see and measure the gain that you have for the business. So I think these are some of the essential aspects for an entrepreneur to look at and ensure that they're able to take the right financial decisions. Over to you, Varun.
So with this, I believe we are done with all the 5 mantras. Thank you so much for enlightening us. But then we are not done yet. It would be good if you can just summarize all the 5 mantras for our audience. So in case if someone has joined us late, so they can also get a quick recap about it.
Sure thing. So let me very quickly summarize whatever we have discussed. So we spoke about finance strategies and why it's important for any entrepreneur to know his financial strategies. And then we also discussed about the pricing mantra, so that the product or service is not overpriced or underpriced, and they're able to arrive at a right pricing strategy. We also looked at the profit mantras to see where and how an entrepreneur has the flexibility to play around with the means that are within his parameters. So profit mantras we saw. And then we saw upon the most important one, the cash mantra, to see how it's very, very important for an entrepreneur to plan his cash flow and take the right steps for his cash. And lastly, we saw the right financial decisions that needs to be taken by an entrepreneur, so that they know the risk, the impact on cash flow, P&L, and so on, so that it's taken in the best interest of the business. So Varun, I would also like to just mention here that I do take business coaching sessions for entrepreneurs, and I also conduct finance workshops. So in case anybody is interested, they could always reach out to me.
Right, Sangeeta, move to the next slide. So this particular slide has all the information. So in case if you want to reach out to Sangeeta, you have the URL, the website, you have the email ID as well. You can also reach out to her on Facebook and other social media network as well. So that's the information about Sangeeta. And then when we move to the next slide, it has information on Zoho Books. So for all the audience, for people who have joined us for the webinar, I'll give a quick line or two about Zoho Books. It's a cloud accounting application, which is also tax compliant. We have different editions for different regions. So we have one for India, which is GST compliant. We have one for UK, which is also MTD compatible, so you can file your VAT returns. We have a different Gulf edition, which is again VAT compatible. So we have FTA accredited solution. So you can raise invoices, accept online payments, and even file your taxes. It comes with a free 14-day trial. All you need to do is simply go to this URL, zoho.com/books, create an account and start using it. So that's it from our end. I would now once again pass on the mic to Sangeeta in case if she has some concluding words or some piece of advice for all the entrepreneurs who have joined us.
I would like to wish all the entrepreneurs the best, the very best in their financial journey, and I really want their financial growth to be in leaps and bounds, and to see a lot more financially successful entrepreneurs all around us, because I think that's really what is essential for the growth of the economy.
Perfect. Thank you so much, Sangeeta. Thank you so much for taking the time out, and we'll definitely start putting all these words into practice. Thank you everyone for joining us for today's webinar, and hope you have a great day ahead. Thank you and bye-bye.
Bye.
And we'll definitely start putting all these words into practice. Thank you everyone for joining us for today's webinar, and hope you have a great day ahead. Thank you and bye-bye.
Bye.